All right. Today we're going to look at the S&P 500 as we always do at the beginning. You can see we have the S&P blasting through its 50-day moving average, which was a big deal. We noted that last week. And the next step um, is the 200-day moving average, which is at 465. Right now we're at 497. So we have a while to go before we get down to there. But you can see that we had a big sell-off today. We had rates going up all week long, and that is causing the market to sell off. So hold on for a second. Okay, so you can see, let's look at our meeting notes. You can see the 10-year Treasury is in an uptrend. This week we hit the top of the uptrend, and as the treasuries are going up in yield, the S&P 500 goes the opposite way. So that was a total dichotomy this week, and right now we're actually we're actually going up with the U.S. Treasury today. So that could help the stock market, but we're actually um, we've broken through some support. You can see that we've broken through um, this 50-day moving average, and now we had some support right here, this channel. Now this channel, if this is broken, that's pretty bad, but we're actually oversold right now. So there's a very good chance, I'd say greater than 50% chance that we'll bounce from this spot right here because we're totally oversold and we have earnings coming up. If we don't bounce here, then the next logical step is hitting the 100-day moving average. And the next step after that is the 200-day moving average. So you can see that right now, the S&P is between the 200-day moving average here and the 50-day moving average. And most stocks in the S&P are between the 50 and the 200-day moving average. So we're losing momentum in a major way in the stock market. If we look at our momentum indicator, this website here, we were at 56% above the 50-day. Now we're at 33%. So we're drastically losing momentum. So any momentum play, the translation for you is if you have any momentum stocks that have been going up on vapor or, or overpriced, then there's a very good chance those are going to be going down due to profit taking. And you can see that 69% are still above the 200-day moving average, which is good because that means we do have a little bit of momentum still left. And once the 200-day moving average in general goes down, right now you can see all the moving averages are going up. The 50-day moving average is starting to go sideways. If these start going down, then that's a sign there is no momentum left in the market. So so we do have earnings coming up. So we're totally oversold. And let's see what our other notes are here. We're down 2.5% this week. We had a total rise in interest rates up 4.5%. That is a lot. And that was due to most likely signs from the Fed or from the economy that they're not going to be cutting interest rates, which is one of our catalysts for markets going down. If the not cutting interest rates was our major reason for a stock market to go down, and that's been happening. We've had we've had some tit for tat banning this week. We had China ask Apple to remove Instagram and WhatsApp from the China marketplace. for, I mean, the China App Store. So that is like a one-for-one um, response to TikTok ban in the United States. So that's really bad for Facebook, actually. So we expect Facebook to be hurt with that. Okay, so what else do we have to say here? We have okay, so we're losing momentum. The revert to the mean is definitely on again. We have healthcare, telecom, financials, energy all outperforming because they're more safe sectors. And right now, risk on trades are not doing good and they're going down. So everyone's reverting to what didn't work last year. So right now, the S&P is still around 20. So that is still overpriced. So it could go down 20% and be basically average for the past 20 years. Okay, so April is usually the best month, one of the best months of the year, but we've had the first 3 months of the year, we've had a lot of momentum stocks carry the market, and now they're kind of deflating a little bit. So it's going to make April a little bit flaky. Okay, S&P, you can see the our trend line is pretty much still intact. We have um, the S&P still between the 50 and 100-day moving averages. It just broke through this channel that started way back in November of last year. So now if we see this continue to go down, we have this as a buffer and this as a buffer. This is like a support. So let's look at some more things. We already talked about the U.S. Treasury. Um, let's look at the 2-year Treasury. It's the same exact chart. It's going, the S&P goes down as it goes up. And it's interesting, we have oil going down with like 5% this week. With all the tensions in Israel, Iran has starting a war, possible, and I'm surprised that oil is down because, there's a possibility of a war in Iran and a major oil producer. That would reduce supply. Reduction in supply means the higher price. So I'm surprised it's down, but as the price of oil goes down, that helps inflation. So that's a good sign for the stock market. Inflation hasn't changed. It's still around 3.5%. And we have the US dollar index unchanged basically from last week. The gold is up 1%. People are um, gravitating to gold as we have a lot of uncertainty in the stock market. A lot of the tech stocks are going down. And um, this is a safety trade with inflation. As inflation goes up, the gold retains its value over time. Okay, so this is we've been waiting for this for since November, actually. We haven't had fear in the market for a good couple months, 6 months or so. And investors have been okay, so investors are afraid now. They're actually trying to buy protection and they are being more conservative. All right, so now the AII sentiment survey says that majority of participants are equally bearish and bullish. Actually, yeah, about bullish is 38, bearish is 34. So we have about equal bears to bulls ratio. So whenever the bearish gets up to 60%, that's when we know it's time to buy. That's a contrary indicator. Okay. So as the number of bulls goes down, the price of the stock usually goes up. So in this case, we have high bulls right here, and the price and as the price of the stock goes up. But as the market sells off, the number of bulls goes down and turns into bears. So it's a contrary indicator. And the U.S. dollar isn't changing. The investors are actually getting trying to get more protection. As you can see, it was at 13. It was in a trading range for a good 6 or so months. It was basically almost zero. Now it's gone up, the VIX. So so that means people are buying protection and they're afraid. And that's whenever we're at here right now. Complacency, we're still at a kind of complacency, but um, whenever we get up to 35, 25, then we have almost extreme fear. Okay, so we finally gotten to a point where we have fear in the market, possible capitulation. And whenever what happens in a stock market, let's take a look at um, the S&P 500. Let's go back a couple years to whenever we had a crash. This is it right here. Whenever we had a crash in the stock market for COVID, we had an inflection point right at the bottom of the selling, and we reversed the same day. That's called an outside reversal, whenever we go down a lot and we end the day up. A lot of times whenever, look at this, we had like this little sell-off here. If we go down 2 or 3%, 4%, and close up a day, that's an indication that a trend is over and we're going to start going up instead of going down. So so that basically hasn't happened yet. So let's look at we were down 2% in the stock market today, but we've recovered some. So that's a positive sign. We're oversold. And okay, let's look at okay, so let's look at some of these ETF sector charts. Okay, you can see that almost every one of these sectors is oversold right there. And we're breaking out of channels that we've had established since last November. And so any momentum trades that you have are at risk right now. Anything that's run up that's overpriced, um, it's people are going to be taking profits from that now. And the key learning experience from this, as soon as we saw that break out of the channel that's been going up for a while, we have to take that as a hint to make sure that you're not in some of the trades that have been going up on vapors and have been going up on momentum. So the trades that have been going up on momentum this year have been AI, they've been the drugs for obesity, and some of the plays around AI like Supermicro, they've been going up without a whole lot of earnings. We've to back them up. So we've flagged that along the way. But what's going to happen if we continue our sell-off? We're going to have the stocks that are stable, that have earnings, hold up better than the stocks that don't have the stable earnings. Okay, so let's look at some of the sectors here. We see the defense sector is still within its channel. Actually, we have it's oversold down at the bottom of its channel, but it hasn't broken through like the other ones. It has a positive catalyst that there are multiple wars in the Mideast right now. So that's going to lead a lot of the defense companies to appreciate. And actually, a lot of the defense companies have not followed and have not gone up in the past couple of years. And this could be one of the sectors that actually outperforms this year. Let's look at gold. Gold is still exponentially going up, probably due to the fear of inflation and a lot of the spending America is doing and a debt that's accumulating on um, in America. So gold is actually um, it's one of the best performing sectors this year. Let's look at the XLY. XLY is consumer discretionary sector. This is um, I guess car companies, a lot of things that are discretionary in nature fall within this category. So if you have problems with the economy and consumers spending, this sector is not going to do so good. But this is going sideways. So you can see it's oversold right now. Um, okay, XLB. This is material sector. You can see that this is in an uptrend. Um, some of the catalysts for materials are a lot of the commodities are going up this year, uh, such as gold and copper and um, uranium. And that's because it has to do with the dollar. It has to do with um, a lot to do with the dollar because all commodities are priced in dollars. And right now we're oversold there, but it's still in an uptrend. So this is in a zigzag pattern up. XLC, this is the communication sector. And this holds stocks such as um, Google, Facebook, and related companies. And so it is starting to break out of its long uptrend. Let's hope that it continues going up like that. It's oversold. Almost every sector we're watching is oversold. XLC is the communication sector. Um, we already talked about that. Healthcare. Healthcare was one of the best performers so far this year, and it broke out of that uptrend, and it's starting it's almost like in a sideways pattern, like right here now. But this is one of the most defensive sectors in the stock market, and if the stock market sells off, this is where people are going to gravitate to for conservative investments. So it looks like we're in a pattern like that right now, and they pay a dividend too. So that's very attractive in this kind of environment. Okay, let's look at XLI is industrial sector, and um, it broke out of its long-term uptrend, and it went through its 50-day moving average. So it's oversold. So almost every sector is oversold right now. And the XLP is the consumer staples. This is one of the most conservative sectors. They pay dividends. They're like Procter and Gamble companies that sell products like Tide. So they're basically have been in an uptrend all year, and they've moved to a sideways pattern that they've been in last year. And um, they're naturally a great type of stock to own in this environment. It's stable demand. People still buy their Tide when there's economy and inflation. So that's good. Let's look at XLF. You can see that XLF has been in an uptrend, and they're still they're still well within right around their 50-day moving average, and they still have momentum in this sector. So that's a positive. And they had basically good earnings too, and when they came out with the earnings in the past 2 weeks. This little dip here is from some of the banks sold off, like JP Morgan, based on some of their earnings projections. So let's look at XLU. This is turning into one of the better sectors this year. It pays a dividend. It's the utility sector, and you can see that it's in a sideways. It's in a upward channel right now, and it's been oversold. Now it's going up. Um, Rats. Okay, let's look at the XLRE. This is real estate, and with the interest rates not being cut and being high, this affects the real estate sector, and it puts a lot of stress on mortgages and people and corporate housing, no, corporate offices. So until the interest rates are cut or go down, this is going to be a very stressed sector. Let's look at XLE. This is one of the worst sectors from last year, and it's turning into be the best sector this year. Right now, it's in an uptrend. It's oversold, and there's a lot of the price of oil is very volatile right now, but it seems like it's been going up due to problems in the Mideast. So it looks like this continues to be one of the better sectors. EWZ, we're following this. You know, it's a Brazil ETF. It's in a kind of an uptrend. These EWZ, the stocks that are compose this index, they're one of the cheapest in the world. They have low PE ratios and a high dividend. So it's kind of a conservative thing to own at this time, and it's a little diversified. Uranium ETF. It is in an uptrend with the materials. It's kind of mirrors the material sector. Okay, let's look at some of our stocks we're following. A lot of the um, drug stocks are following the XLP, which is the drug ETF. They were in an uptrend for a while, and now they're kind of breaking down like the rest of the stock market. But they're all oversold. Um, Abbott Labs, they had a bad earnings report, so they went down. And Jim Cramer still likes this stock, so um, it looks like Abbott's in a downtrend right now. Let's look at Alibaba. It's been in a sideways pattern for a couple months now since the beginning of the year. Um, doesn't look like it has any momentum. And let's look at Google. Surprisingly, this is one of the best performing Magnificent Seven stocks this year. Um, it continues to follow this channel. And we were saying last week when Google was at the top of the channel, it's not the time to buy because it's overbought and it's at the top of the channel. But now it's one of the only stocks we're following that's above its 50-day moving average, 100-day, 200-day. So it has a lot of momentum still, and probably because of the AI ambitions and its stable earnings. The reason I own Google and keep owning it as one of my biggest positions is it's been growing at 14% a year consistently, and it's been doing that for 12, 20 years. And they continue to grow at that pace. And earnings projections are still growing at that pace. So, you know, in a bad market, I think Google can go down to this, you know, the 200-day moving average, which is right here. So, still, it's not a good time to buy Google. The time to buy it is whenever it's at the bottom of the channel and the stochastics are pretty low. So, yeah, I guess Google is one of the stocks that are following the channel still, and it's not hasn't broken out of it. Don't I know this is Altria. It's in an uptrend with a lot of the dividend related stocks. It's a small uptrend, but still, um, it's paying a dividend as the interest rates. Um, um, if they were to go down, that would help Altria here because they pay a high dividend, and as the the price of the treasury goes down, the demand for yield, such as a 9% dividend from this company, goes up. Okay, let's look at Apple. Apple is it was in this trading range for a long time. I guess we still are. Um, we're at the basically at the bottom of this sideways pattern that we've had for almost a year now. So we're in a downward channel, but I think the overwhelming um, pattern right now is where we've hit. This is support from last November. This is support from last 2 Mays ago. So we're at a point where we have a lot of support. So it's a very good chance that we're going to be going in this pattern right here for a while. I guess the good thing about Apple is that it pays a dividend and it's consistent. It has a lot of earnings, more earnings than any other company. But the bad thing is it's super overpriced. So If it does break this spot right here, then it's totally out of its moving averages. So it's below its 200, below its 100, and they're starting to all point down, which indicates we're in a downtrending situation for this stock. This is one of the first stocks that are in a downtrend that we're following, the big tech stocks. All right, let's look at AT&T. AT&T is sideways. A lot of the dividend paying stocks are basically trading sideways. It wasn't an uptrend this year, but it seems like um, this kind of goes right along with the interest rates of the 10-year. So as the interest rates go up or remain elevated, the demand for high yielding stocks goes down. Okay, BMY is still in a super downtrend, and it's in a sideways pattern right now. It's just going nowhere. Their earnings aren't that great. So this is not a recommended stock. We're just following it as a stock to avoid. Okay. And this is Colgate. Colgate was in an uptrend, for a long time, and it's like the S&P is kind of breaking out of that uptrend and kind of going down to sideways. And it's oversold like a lot of the other stocks. CSX also seems to be in this pattern right now. It's going sideways. It was going up this year, since November, but we're going sideways, it seems. Meta is still, this is very similar to Google. It's still in its uptrend, even though it's been selling off recently, from but it is still in an uptrend and it's oversold right now. So it looks like it could be establishing a pattern sideways. Let's see if that happens. And JP Morgan is totally oversold, and it's breaking out of its yearly its run from the beginning of the year. So you have a lot of stocks that are actually starting to break out of trends right now, and you have to look at the moving averages for each of these stocks to make sure if it breaks the 200-day moving average, that's a sign that it could go sideways or nowhere for a while or down. But right now we're oversold. And when you're oversold, Jim Cramer says you have to hold your nose and buy if you have money. Otherwise, you don't sell whenever everyone else is selling. Okay, Microsoft. This is an example of a stock that was in an uptrend since last September. And it's an example of an AI stock. And it's 100-day moving average right now and oversold. So there's a good chance that with earnings, a lot of these stocks will break out of their if they have good earnings, they'll break out of this downtrend and go to an uptrend at top of the channel. But if we have disappointments across the board for a lot of stocks, we're going to move from an uptrending market to sideways to downtrending. So this is like an inflection point right now. So if you're over your skis in momentum stocks, we've lost momentum. So you have to either go into more conservative trades or you have to not sell, not, you have to be a little more conservative when we're losing momentum. Okay. So Pepsi is one of the best performers this year, and it's a safe type of stock to own in this kind of environment because it is paying a dividend and it's consistent demand for their products. Okay. So and Procter and Gamble is very similar. We're in a kind of sideways pattern for a lot of the dividend paying stocks. Let me see. So I guess a lot of these remaining stocks, Waste Management is in an uptrend and it's oversold, but it's an example of a stock that's a very strong demand in good times and bad. Let's look at some of our meeting notes. Okay, So we already talked about the okay, so the worst, the first is playing out very, very much as expected that we thought at the beginning of the year. We have healthcare, energy, and consumer staples still doing good. Utilities are still doing good, and financials are one of the best, and energy, some of the best sectors. IT and communication services are still good, but um, it seems like all the ones doing good and bad today are the conservative sectors. Let's look at the Dan Now's picks. They're not as good as they were last week, but they're still Amazon and Meta are doing great. Um, and XBI and KWeb are not doing good. They're the ones that need XBI or biotechs. They need to borrow money, and as interest rates aren't going down, they're strapped for the cost of borrowing money. Let's look at okay, we already talked about most of the indexes are breaking out of this channel for a long time. So that's a good indication we're going to go sideways or down in the near term. All right, so we already talked about gold. Um, we went through a lot of these charts already. Okay, so I'd like to review this sector performance. A lot of times, right now, we're in a downtrending market. Whenever everyone's fearful, um, the sectors that do good in this environment when there's a sell-off, conservative sectors, ones that pay dividends, such as the health sector, you have the financial sector, you have telecoms. Okay, so the stocks that they didn't do that great last year. Healthcare didn't do good last year, and utilities did really bad. Energy did really bad. So this year they're outperforming. And the key to investing is you can have a little bit of different sectors, so that you can have a diversified portfolio so that in times like this, your portfolio isn't taking a big hit whenever all the stocks are going down. Okay, so I looked at another video from CNBC. Jim Cramer has a show called Am I Diversified? Okay, so I went over, and listened to what he advised for these. Um, the first scenario, we had Jim in Colorado. He said Charles Schwab, Apple, Caterpillar, AT&T, and Lockheed Martin. So Charles Schwab it's a brokerage, but it's also a bank. It's one of the biggest banks. So that's a bank, a financial company. You have Apple, which is they make hardware, the iPhone, and they have services. So they're a tech company. We have Caterpillar. They're a manufacturer of moving equipment and big machinery. We have AT&T, which is a telecom, and we have Lockheed Martin, which is a defense contractor. Um, and Jim was asked, am I diversified? So we look at these. We have financial, tech, we have machinery, telecom, and defense. And Jim Cramer said, let's see what he said. He said, there's no changes. That is totally diversified. The people in Colorado are awesome. So we see how we have a little bit of different sectors. So in this, let's say for today, whenever the stock market's going down, we have tech going down. We have, yeah, as tech goes down, let's say we have, and maybe Caterpillar goes down, like diversified industrials. And the ones that are doing good today are telecom. We have banks doing decent, and defense outperforming. So that's an example of how you can have a portfolio diversified to handle any situation in the market. Let's look at another one he said. Okay, the first one is Apple, American Electric Power. They are a utility company. Illinois Toll Works, um, Pepsi, and Union Pacific. So we have a consumer product like a food company. We have a rail company. We have an industrial company and a utility that pays a dividend. And we have a tech company that has a dividend. So if we look at those, you know, what do you think Jim Cramer would say for this portfolio? All right, let's see what he said. No changes. It is well diversified. We have a tech, we have a utility, which pays a dividend, and this tech pays a dividend too. We have an industrial, and as the economy does really good, the industrials do really good. And if we had a recession, the industrials won't do that great. Pepsi, right now, it's one of the best performing stocks in this market, and it pays a dividend. And Union Pacific is a rail company, and they're a total one-to-one correlation to how the economy does, because as the economy does better, there's more shipments on the rails. So what do you think? Yeah, so basically there's no changes in that portfolio. That was an awesome portfolio. Let's look at this one. This portfolio is Apple, Disney, Tesla, Cloudflare, and NVIDIA. So we have Apple, a tech company that's a service company. We have Disney, which is a media company. Tesla, a car company that is 30% tech. We have Cloudflare, which is a manufacturer of products for the servers for the cloud, perhaps. And we have NVIDIA. So we have a tech semiconductor company. We have a car company, another tech company, Disney, which is a media company, and company for servers. And what do you think Jim Cramer said about this portfolio? All right. Well, he said there is a lot of tech in this portfolio, but he likes these. They're diversified enough to keep them all in the portfolio. But he removed Cloudflare. He thought it was a very similar correlation to NVIDIA. So he added Eli Lilly instead of Cloudflare. That was a good little exercise. Um, there's an article that came out. How much do Americans think they need for retirement versus what they actually have saved? So basically what's happening is um, Americans aren't saving that much. I mean, the average amount that people save for retirement is maybe $100,000 for a 50-year-old person, maybe 30,000 for a 40-year-old person. So it's way off of what they really think they need. Um, and what we're finding here is in the year 2020, it was less than $1 million is all people thought they needed for retirement. 2021, they thought they needed 1,050,000. And then 200,000 more 2022. And then we go up to 2024. Everyone thinks they need 1,460,000. So what's happening is people are upping what they think they need based on inflation, longevity. So people are Gen Xers, millennials are thinking they're going to live past 100 or to 100. And so what we're seeing is people are not saving enough and they're expecting to need more for retirement. So the takeaways from this are Americans are worried that they're not going to have enough. And you have to make sure that taxes are like one of the biggest costs for Americans. So it's very important to understand your taxes and do tax sensitive things that'll help your retirement goals. All right. So there's an article that came out about Netflix. As we can see from, well, let's look at our count. Okay, the article is Netflix stock sinks on disappointing revenue forecast. They are actually growing their customer base at 16%, which is pretty amazing. But their forecast was not that great. So forecast always trumps, whether you beat your quarter or not when you're reporting earnings. So so they went down. That is like Netflix is considered a bellwether stock because they were hooked into that FANG, top stocks for a while. So there, anytime any of these big Magnificent Seven or FANG stocks reports and they don't do as good as expected, the stock market sometimes follows. So that happened early this week, and that could have helped the stock market going down 2.5%. And as we get the other earnings for the big tech stocks reporting next week, that could likewise affect the market in a major way, good or bad. So we're at an inflection point with the stock market, and um, if any of these big tech stocks give a bad report or bad outlook, there's a very good chance that the stock market might go down. But if they report better than expected earnings, then we could bounce from where we are right now. I'm I think we there's a good chance we can bounce with good earnings. But we have to be prepared for anything. Okay, so I'm going to review one more thing. Um, the is when to buy, when to sell. We're at a point right now where the stock market is sold off and we're at the bottom of the channel and we're oversold for a lot of the stocks we're following. Um, what I didn't say in this chart is if we break the channel, if we go down right here, or if the stock price goes down to here out of this channel, that all this stochastics doesn't work. So in other words, when we're looking at the S&P, let's see. Okay, when we're looking at, let's look at the S&P. Okay, when we're looking at the S&P, we see we have this long-term uptrend. Whenever we break out of this and we start going down to here, it's going to be oversold for a long time, and we can't use stochastics to time buys and sells. It's just all over whenever it breaks out of channels. Um, so I'm just saying that because stochastics are only useful whenever you're you're in an uptrend and if things are in a channel. So pretty soon we're not going to even pay attention to these up channels anymore if we start breaking out in a major way. So that's something to keep in mind in the back of your mind that this only works in an uptrending market. All right, so you see. Okay, so I think let's look at a couple more things. What's going up and down in the market today? We see there's Paramount Global's in this um, takeover. One day they're going to be taken over, another day they're not, and so it's going up and down 12%. A lot of the banks doing good today. Um, they're all conservative. They pay dividend, and let's look at the ones, and they've had good earnings this year, last week. So that's one. Whenever there's certainty in a stock, certainty meaning the earnings are released and they were good, that's a good um, reason for them to start going up. A lot of the tech stocks, these are a lot of these are momentum stocks. These are stocks that went up with um, momentum trades, and we have all AI companies. Okay, so this is um, what's happening right now. If we look at our reasons for the market to sell off, right here, we have AI companies. Okay, AI companies going down. Let's see. Let's look at. They're right here. So AI stock bubble bursts. Tesla has started going down. Now all AI is going down. So that's a good reason that we have capitulation. So we've been saying that's a possibility for a long time. But just today, you can see a lot of these AI companies, almost every one of these is AI companies is starting to go down. Let's look at the NASDAQ. can we see a lot of the dividend paying stocks are going up. These are utilities and dividend paying companies and drug companies. And the ones doing the worst are the AI companies right now, and the ones that have been in a super uptrend all year long on AI. And the ones that are doing good in the Dow, a lot of them are dividend paying ones. The ones doing the worst are some of the Magnificent Sevens and tech stocks, AI stocks. All right, that was a good little exercise. The sectors going up and down the most. Let's look. Wonder why only three are there. That's strange. Try this again. Okay, so we see technology doing the worst, down 2%. Communication services, I guess that's Facebook and Google and a lot of the related big stocks. Um, Utilities, financials, this is the best, the worst. The ones that are doing the worst last year are doing the best now. So our predictions at the beginning of the year are starting to come true. All right, so that was a good little exercise. All right, so right now we're basically, let's look at the S&P 500 in general. Okay, so what we have is we have an oversold market, totally oversold. Let's look back at where we had support before. This is the COVID lows. We had support here and we have support here. Right here we have support here. You can see this is where the stock market went down and it stopped. It stopped here, stopped here, stopped here. And right now, yeah, we're in a spot where we broke a lot of our moving averages, and we have one spot down here at 470. And a lot of times that's like a natural um, floor for the stock market. So looks like a lot of the froth is coming out of the market. The ones that have been doing really good are starting to go down now. So that was good exercise. Let's look at the what's happening next. We have tech earnings coming up next week. And if they do good, then the stock market is going to recover. If not, we're going to basically go down to the next moving average, which is down to here. We have a 100-day moving average and we have a 200-day moving average. And if we break some of that, then we have to look at levels that held before. So we're in a sell-off. This is fear, ladies and gentlemen, and um, right now things are still overpriced. We've been saying it's 25% overpriced for the stock market forever, but um, it looks like there's air coming out of the balloon of the AI companies. That's what's causing most of the problems, and the conservative sectors are holding up okay, actually. And you can see banks are like super outperforming now. A lot of the conservative ones are still doing really good. Google's even only down 1%. I'm surprised it's held up so much recently. Meta is down, most likely because of the ban of Instagram and WhatsApp in China. So Apple took that out of their app stores. And okay, that's interesting to see if we hold these levels we're at right now, and if not, we're going to see a major reversion to the mean for what did good last year. Could start. You see, hold on. Okay, so we could see a further turn of this. So the IT, what did good last year, might start turning negative. And the things that did bad last year could super outperform the tech stocks. So let's see if that continues. That's why it's important to have a diversified portfolio and to make sure that whenever you invest that you're well diversified in each of these sectors. So right now, the ones doing the best are healthcare, utilities, and energies and telecoms that did bad last year. So let's see if that continues. That was a good lesson learned. And I hope you have a good weekend. And let me know if you have any questions. And have a great week. Talk to you later.